Hello all. Welcome to one another lecture. So today we are going to see an important topic, which is the market abuse regulations. So before that, thank you for all the support, and the channel is growing due to all of your love and support. Keep showering this and keep on sharing and keep on subscribing. So let's quickly dive into the topic. So what is market abuse regulation? So before going into this, so let's understand what is market abuse. So in terms of economics and finance, market abuse is nothing like it is kind of a situation or circumstance in which investors in a financial market have unreasonable disadvantages. So these disadvantages may be arising due to facts such as few investors have information which is not publicly available. This is also known as insider dealing. Moreover, there may be situations in which price of particular financial instruments might be distorted, or let's say there has been misleading information circulating in the market, for which few of the investors lose their ground. So this kind of behavior in the market is known as market abuse. Now, what is market abuse regulations? So the market abuse regulation is a piece of European Union's legislation that was introduced on July 3rd, 2016 to combat these kind of market abuse. So it is nothing, it's a piece of legislation which is aimed at preventing the market abuse in simple terms. This regulation applies across all EU member states. Whoever is a part of the EU, these regulations apply to all those countries and the states. So in layman's term, this is what market abuse means and market abuse regulations meaning. And this is the timeline. So the same thing, the market abuse regulation enhances the market integrity and investor protection across the EU and UK, critical for fair trading. So bringing in this regulation kinds of brings investor confidence back to the market. Now, the MAR or market abuse regulations, there are a total of 69 articles spread across various headers. So these headers are insider trading, market manipulation, public disclosure of inside information, and so on. So this legislation comprises of a total of 69 articles. So this is a pointer which needs to be remembered. What are the key provisions of the market abuse regulations? So we saw that there are 69 articles across various headers. Now, what are these provisions or the key provisions in this regulation? The first should be the insider trading. So, basically, this regulation prohibits individual with inside information from buying or selling financial instruments based on that information. So you have seen many of your colleagues maybe or people you know complaining, or let's say kind of saying that they are working for a financial institution and they are not able to buy securities. So This is one of the provisions why they are not able to buy, because some of these people who works in a financial institution on all this, they have sensitive information. Hence, they can manipulate the market. Hence, they are restricted from engaging in securities trading. The next would be market manipulation. So again, prohibits activities intended to manipulate the price of financial instrumentation, such as spoofing, that is, placing fake orders to manipulate price, front running, or any kind of activities that distort the market. Again, let's say uh, I am working in some kind of a financial institution. I have some proprietary information with me. I might try to manipulate this information and use it in my advantage to get people to buy some kind of shares. So that's why this is also prohibited. The next would be public disclosure of inside information. So this is also on the similar lines, where when there are information which should not be disclosed, let's say there is a merger going on, acquisition going on, so these are very sensitive information. So if these informations come out in the public, then the course of the market can be changed. So these regulations prohibit individuals to disclose inside information. Then comes the suspicious transaction reporting. So these regulations also puts firms in a position where they have to report suspicious transactions to regulators. These firms are expected to identify and monitor trades that may involve market abuse or insider trading. Next would be the record keeping. So this regulation again requires companies to maintain comprehensive records of financial transactions and communications, so that while auditing or when a regulator requires these things in an investigation, it could be handed over easily. These were the provisions in the MAR. Now let's look at some of the key articles. So you will find similarities because these articles are looped into or grouped into these key provisions. So these are some of the key articles. So Article 3, which relates to market abuse. Article 6, which relates to insider information. Article 8, which relates to insider trading. I would suggest you to pause this video and go through each of these articles. These are really important articles in the MAR. Next, we have Article 10, which talks about insider lists. That is, this article requires firms to maintain insider list that includes the name of individual who have access to inside information. So based on this, controls can be placed. Then there is Article 12, insider dealing and market manipulation. Article 15, disclosure of inside information. Then we move ahead with Article 16, delayed disclosure of inside information. Article 18, market manipulation, that is prohibited practices. Article 19, managers transactions. So, which imposes basically obligations on persons who hold managerial positions in companies, such as executives or directors, to disclose their personal trading activities in a company's financial instrumentation. So this basically ensures that there is a transparency, and it also helps in preventing insider trading. Then we have Article 20, which talks about reporting of suspicious transactions. Article 22, which talks about one of the most important programs in any of the organizations, you can tell, is the whistleblower protection. Those people who report anything suspicious or anything needs protection. So Article 22 was introduced for whistleblower protection. Then there is Article 38, there is cooperation with the third countries. So this article kind of outlines like how the framework should be between countries and how information sharing should be present. Then there is Article 53, which is sanctions for breaches of MAR. Let's say an institution or an individual or any organization which falls under the scope of this regulations, MAR. If they breach the MAR, what would happen and how are the sanctions being placed is talked under Article 53. So this may include administrative fines as well as criminal sanctions depending on the severity of the offense. So once again, I request you guys to just pause this video and go through all these articles. These are the key articles. Also, you can go ahead and download the entire article list and go through all the 69 articles. So now, kind of, let's look into one of the headers or one of the X or one of the pointers of this MAR, that is insider dealing. So what is insider dealing? Let's say. So insider dealing is the illegal trading based on confidential and non-public information. So if you have any kind of information which has not yet hit the market, you know that there is going to be a stock split, or let's say there is going to be certain kind of IPOs, certain kind of there might be some kind of acquisitions, mergers. So these are the information that is not available to the public, or your organization has taken a big project. So you can go ahead and use that information to buy shares and sell it in a higher like prices. So this is kind of illegal. So Article 8 of the MAR defines insider dealing and outlines its regulations. Now, example of insider dealing, a corporate executive trading shares after learning about a merger is one of the clear examples. What is the impact on an investor? Insider dealing basically undermines investor confidence and market integrity, because 90% of the market or 99.99% of the market won't have that information, and once the trust is breached, it is very difficult to trust again. So there is the regulatory scrutiny, that is, regulators are keeping a scrutiny and enforcements are kind of given on this kind of violations. So there are again penalties, severe penalties are there. If people are found that they are into kind of insider trading or insider dealing, then this leads to market price distortion. Insider trading will definitely lead to your distortion in the price. Then now MAR brings in the transparency and fairness in the financial markets. So you can pause it and you can look into the recent prosecutions and why is it required. Now let's focus on real world cases that are based on the MAR. So high profile insider trading case. So a corporate executive was prosecuted for trading on confidential merger information, highlighting MAR compliance importance. So here you can see that this was done, and based on MAR, the executive was prosecuted. Again, market manipulation. Traders artificially inflate stock prices through coordinated trades. Let's say there is a group of traders and stock is, for example, selling at, let's say, $1, but there are 15-20 traders who have formed the lobby and they are buying the shares for $2, for $3, for $4. So what happens is, like, the price of the share, which was originally $1, goes up till $5, which is artificially inflated because the pull is not from the market but from a group of traders or individuals who have come together. So this is kind of market manipulation, and MAR prohibits this. So these are few of the examples that has happened in the world. You can go ahead and search, do a Google search and get many case studies on these kind of incidents.